Welcome to YieldNerd, an educational show about how you can acquire and manage yield. All right, we're making good progress. And to keep videos a little bit manageable, I'm chopping them into 10-minute sequences, so I hope that is easy for you. In this part of episode 8, we're going to be looking at how to pull up a preferred stock on a brokerage, how to look at the various parameters and understand them and relate them to the types of preferred stock we saw, the risks of preferred stock we saw, and so on, and perhaps even evaluate a company or two, the issuer and the instrument, that sort of thing. So let's get moving. We very briefly touched upon this in the previous episode, but on Schwab, again, no affiliations with Schwab. On Schwab, you would go to research, and from research, you would go to stocks, and within stocks, you would see the preferred screener. So go ahead and pull up the preferred screener in whatever brokerage platform you use. And once you're there, you're going to see that there is a whole bunch of selection criteria that you can use. And that is where you can, for example, say, I want an yield between X% and Y%. I want this sector, but not the other sector. You may remember 84% of preferred stock is from the financial sector. Maybe you want to exclude that. Maybe you want to look at preferred stocks that are not in the financial sector. That's actually what I set up just to show you what you get. You, in general, you want cumulative preferred stocks. And for those who are comfortable with non-cumulatives, of course, you can filter it differently. And I set it to convertible preferreds for a specific reason, and you're going to see why, and the notion of what is called the convertible arbitrage, which is a very important concept in preferred stock. So once you click all of those choices, out comes a list of preferred stock that meets that specific criteria, and we're just going to pick on one of them, and this is RBCP. I'm making another disclosure. I am not affiliated with Roll Bearing Company. I do not own RBC stock as of this date. I do not own RBC preferred stock as of this date. This is purely educational. So we're going to look at RBC bearings. They're preferred. And the first thing you're going to notice is that it has a certain name. It tells you the coupon, which is 5%. It tells you it's convertible. And so we're going to click on that. And that gives you the next level of detail. And what you see is that it has a coupon of 5%. You're going to see that it's trading at $105. In general, preferreds trade at 25 bucks, 50 bucks, or 100 bucks par value. So this is trading above par. And as you look at the same screen and look at additional details, you're going to see that the yield right now is 4.69%. The only reason the yield is less than the coupon is because the preferred stock is trading above par value. So instead of 100, it's trading at 105. That means the coupon it generates is not worth 5%, it's worth 4.69%. That's what it's trying to tell you. We do want to make sure that we only get cumulative stocks in this particular scenario, so we're verifying cumulative equals yes. The face value is 100. What that means is on the maturity date, the stock will convert based on whatever the face value is at that time, the par value is at that time, and that means it will convert at an equivalent of 100 even though you paid 105 for it. So it's very important that you understand that very clearly. In terms of calls, you can see that there is no slated call, which is in general a good thing. If you bought the preferred at par or above par and there is a call right away, then you have a call risk as you saw earlier. In this case, the call risk is not there. However, there are provisions called extraordinary calls. In general, they'll be there in most preferred stocks. And that is that if the company were to be acquired by somebody else, the acquiring company may have the right to automatically call the preferreds and so on and so forth. And finally, we're able to see that the convertible is yes, and we see the conversion ratio. What does that mean? Every $100 of RBCP converts into $44 of the underlying stock. What that probably means, as you can imagine, is the underlying stock trades at a much higher numeric value than the preferred. And as a matter of fact, that is what we're going to see shortly, because one stock of the preferred is worth less than half of the underlying equity. So let's see what that is and how we can understand that. Um, Before I did that, I thought I would point you out to a little problem here. We see here that the conversion ratio is a fixed number, 0.4413, but there is a problem. It's no ordinary problem. It is a big problem. That information is incorrect. Let me repeat. On this particular brokerage, you are given one specific number as the conversion from the preferred stock to the equity, and that is incorrect. So on the brokerage, you are seeing incomplete, incorrect information, and you have to ask the question, well, where do I go for the complete information? Once more, I have indicated I'm not selling anything, I'm not representing anybody, everything I tell you is education. One good site where you can go to get information about a preferred stock is called Quantum Online. Quantum Online is a free site. You register and you will be reminded to donate, and you can donate as you see fit. And you can donate as you see fit. The interesting part about Quantum Online is that it has a search bar, and you can search instead of by symbol, you can enter the QSIP. And once you enter the QSIP for this preferred stock, out comes the prospectus in a reasonably more readable fashion. And you can then review the prospectus and read and see what the conversion ratios are, or ta-da, you can actually notice that instead of the conversion ratio being one specific number, as the brokerage software says, it actually is a range. It is a range that says if the price of the underlying equity on the date of maturity is 226 or more than 226, then one RBCP unit, one stock of the preferred stock, converts into 0.4413 of RBC. If, on the other hand, the stock is trading much, much lower, meaning 185 or lower, in order to kind of give you the incentive to own the preferred stock and say, hey, your downside risk is capped within reason, the company is saying if you were to own the preferred and the underlying equity were to crash below 185, will actually increase your preference, will actually give you 0.54 of the underlying equity instead of 0.44 of the underlying equity. And this is a very, very important concept in preferred stock, which is the range in which the preferred has higher or lower preference. And anything in between 125 and 226, if you read the prospectus, it will tell you that it is going to convert pro rata, meaning if it is at 200, then it will convert exactly at the ratio between the RBCP and RBC at that particular price. It's only about 226 where they don't want to give you an infinitely high conversion. And so they throw the 0.4413 in. And if it crashes below 185, you're again capped, but at a higher number, so you can be rewarded. So that's fundamentally the concept of the range of the conversion. And that is available at Quantum Online. Then we have to sit there and say, how do I know whether on this particular day RBCP is a good deal or not? And turns out you need 3 different screens and a calculator to figure out the answer. On the first screen, you're going to have Quantum Online. You're going to note that, hey, if it is between 226 and 185, it's pro rata. Above 226, I get the lower conversion rate. Below 185, I get the higher conversion rate. What is it now? And today, here's the equity. That is trading at 217, which is the higher end of this ratio. And the preferred is trading at 105. If the preferred is trading at 105, the equity is trading at 217.2, then the implied conversion ratio is actually 96. Here is what this says. What this is saying is, pay me $105.31 for the net value of $96 plus a 5% coupon every 3 months. It's not 5% every 3 months, it's the annualized 5%. So it's 1.25% every 3 months or 5% in total. And that is what this particular preferred stock would pay. And so you have to decide whether it is a right equation. Will you pay $105 today to make the net effect be $96, converting it into equity at the end of the maturity date? And you sit there and go, wait, this looks like a bond. There is an initial value I paid, there is a par value I paid, there is a coupon, and you are correct. If this was a bond, this would be no different than the face value being 96.08. You are buying it at 105.31. You have 2 years to maturity. RBCP gives 5%, but it pays that 5% over 4 coupon periods or 4 coupons during the year. And if you were to plug that into an yield to maturity curve, you will actually see that your yield to maturity is 0.19%. The reason it's a low number is the 5% yield that you get is mostly frittered away in the premium over 100 or the premium over the par value. And so even though you get the $5, even though you convert today, the net effect is a pretty poor yield to maturity, something that'll easily be beaten by treasuries, let alone anything else at this duration. So then the question is there a case where this is a win? I mean, somebody bought it today for 105. And so then you have to ask the question, if someone is willing to pay 105 and they only expect it to convert at 0.4413 of the stock in 2 years, what are they thinking? And the answer is they think that maybe the 217 will become 238 and then their preferred stock will be in the money and they think they are buying low and selling high. If you were to have completed your research and you thought that their stock was going to go from 217 to 238, I suppose you could buy the preferred today and wait for it to go up. That would be one justification as to why they would win that. And now let's review what we call the convertible range. We are setting up for the convertible arbitrage unit. And so that is why we're reviewing conversions at greater detail. To be clear, if the RBC price is $226 or greater, the conversion ratio is 0.44. If it is 185 or lower, the conversion ratio gets a nice little bump. Any value in between the two converts at exactly the same ratio pro rata. So as you can see, in general, the company expects the preferred stock to trade at par. That's why the incentives are aligned with, if it goes too high, I'm going to cap your incentive. If it goes too low, I'll throw in a couple of additional bucks and make it look like your preferred should only be at $100 because that's the fair value. Unfortunately, we've all learned the market doesn't always reflect fair value. And what that means is if you bought RBCP below par, meaning less than $100, you really cannot lose unless the company goes bankrupt in less than 2 years. Because if you bought it at less than 100 when the par value was 100, then you're going to convert at a favorable ratio no matter when it converts and what the underlying equity is. But can you buy the same stock where it is trading above par, and will that still be a smart decision? And to answer that question, what we need to look at is called the convertible arbitrage. We're just going to set it up in this unit and we're going to come back to it later. As you can see, if I were to compare the rate of change of RBC and RBCP, they are in lockstep for May and most of June. And surprise, surprise, there is a divergence between RBC and RBCP, even though their conversion ratio is the same in that period. That's a very important thing for you to know. That's what creates the arbitrage. So in the next part, we're going to set up to talk about the convertible arbitrage. See you then. Thank you. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.